Today, I want to talk about this particular topic. Could the non-farm payroll shift Fed's path for October and December? Right now, what we had so far is a weak August payrolls confirmed by the JOLTS jobs report. Right, the August 2025 U.S. non-farm payrolls report showed just 22,000 jobs, added a dramatic slowdown from July 79. And July 79 itself was already a slowdown, a shocking slowdown. And if you compare it with the August one, it's worse. On top of that, the unemployment rate ticked up to 4.3%, the highest in years. This result was not entirely a surprise. The September 3 jobs report had already hinted at weakness, with jobs openings slipping to 7.18 million, the lowest in 10 months. That decline signaled that labor demand was softening, and the non-farm payrolls confirmed it. Now, this marks a turning point. The US labor market, once the bedrock of resilience, is clearly losing momentum. Sectors such as manufacturing and trade are already showing outright job losses. Analysts warn that when US jobs growth slows this sharply, it can signal either a soft landing or the early stages of recession. Now, looking at the Fed rates, right, the possibility, what we're seeing, definitely the market reacted swiftly because we are, it's very, very sensitive to rates at the current moment. Okay, expectations are very high. Now, according to the CME Fed Watch 2, the probability of a September 17 rate cut surged to 100%, with 79.5% odds of another cut in October and 73.3% for December. Now, this is a striking repricing. Just weeks ago, markets debated whether the Fed might cut once more this year. Now investors are effectively pricing in a full easing cycle, with September a near certainty and high probability for October and December. And you can see it from the table right here, right? Now, Fed officials themselves are laying the groundwork. At Jackson Hole, Jerome Powell shifted his tone after 2 years of inflation-first rhetoric. He acknowledged that risks have now tilted towards the job side. He reminded markets that when the labor market turns, it can turn fast, signaling the Fed's readiness to respond. His comments were echoed by Governor Christopher Waller, who bluntly said, "I think we should be cutting at the next meeting." Now, the message is clear. The Fed sees a slowing labor market as more immediate risk than lingering inflation. That pivot is why markets are leaning so heavily towards consecutive cuts. Okay, so with Fed rate cuts, right? What's next? Other than the cuts, those are the expectations of the market. But what are the expectations of the Fed themselves? And that we can see it from the dot plot. So the big question right now, this is the market expectation, but will the September dot plot move, right? So the Fed's meeting won't just bring policy decision, it will update. This particular one in September will update the dot plot of future rate expectations. Now, in June, the median dot still penciled in 2 cuts in 2025. After August non-farm payrolls, those projections look stale already. That means we are not looking into 2. So if the Fed acknowledges the labor market deterioration, we could see a more dovish shift, with dots migrating lower, which means some participants signaling 3 cuts instead of 2. That said, policymakers will tread carefully. Inflation, while cooling, remains above 3%, right? The Fed will not want to appear to be cutting aggressively into sticky prices. Okay, so the core, if you look, it's been following the core, it's still above 3%, right? So the most likely outcome, a slightly lower dot plot, enough to validate September and perhaps October cuts, but leaving December flexible, dependent on data. Now, investors will study the Fed's dot plot closely to see if policymakers are signaling several cards ahead or if they are leaving themselves flexibility to decide later. All right. So this is the expectation of the dot plot. Now, how does that impact the market? For the S&P 500, right, this stocks initially jump on the prospects of easier Fed policy, but then reverse lower, closing back near 6480. The failed breakout shows that investors are worried that rate cuts aren't just insurance, they are a response to real economic weakness. At the same time, the market didn't outright collapse, if you notice that. And that suggests investors are waiting for bullish confirmations, as you know. And this week's CPI on Thursday could be the decisive market mover determining whether equity stabilize or extend the pullback. As for the US dollars, the dollar sold off hard after the non-farm payroll miss, plunging through 97.40 before settling around 97.65. Now, this reflects collapsing US yield expectations. Still, dollar index did not break down entirely. It's trading in a broader range if you put on the 4-hour time frame and above. A strong move below 97.3 would be needed to confirm a deeper downside trend. Until then, dollar remains range bound, okay, sensitive to data and Fed commentary. That's what I see. But wait for the CPI. Okay. As for Bitcoin, it spiked to 113K on the non-farm payroll release, but quickly gave back its gains, consolidating near 110.9K. Now, this highlights Bitcoin's current role as a risk-on assets, unable to sustain rallies when equity fade. With sentiment still cautious, Bitcoin is likely to chop sideways in the 109.5K to 111.5K range until stock market direction becomes clearer. Okay. So the major test comes with September CPI and the FOMC meeting 6 days later. Now, these events will determine whether this is just a temporary wobble or the start of a deeper growth-driven correction. So just wait, it's just a couple of days only, and we will have a clearer idea then. Right, okay. That's the fundamental report for today. Next.